Did you know that the very lifeline meant to help your restaurant grow could be the one thing holding it back or worse, killing you? You know that easy to get wad of cash to help you get through the tough times? Heck, you get offers on a daily basis from your credit card companies, guaranteed loan companies, even your POS systems today. Hey there, Restaurant Pro. This is Dave Scott Peters, restaurant expert, coach, and creator of the Restaurant Prosperity Formula. And today we're diving into the world of credit card business loans and why they may not be the silver bullet you think they are. Credit card business loans, including merchant cash advances and business credit cards, quickly offer access to cash with minimal paperwork, funding based on future sales. At a glance, they seem perfect. Fast cash to keep your restaurant humming along. But here's the catch. When a customer swipes their card at your restaurant, a portion of that sale isn't going into your account to cover your expenses and grow your business. Instead, it's servicing your debt. These loans come in two flavors: flat fee loans and loans with high interest rates. While flat fee loans might seem straightforward, they can disguise the true cost of borrowing. If you're paying a flat fee loan in a short-term basis, that effective annual percentage rate, the APR, can be astronomical, making it one of the most expensive ways to borrow. With high interest rates, the situation can quickly become dire. The amount you owe can rapidly increase, consuming a larger portion of your revenue, making it harder for you to operate your restaurant profitably. Imagine your restaurant, a bustling hub of activity where behind the scenes, you're constantly playing catch up because a significant chunk of your revenue is going towards repaying a loan. The fast repayment schedule can force you to make cuts in quality and service just to keep your doors open. But it doesn't have to be this way. There are healthier options, right? To refinance, or to finance, I should say. Well, there's traditional bank loans, often hard to get, right? SBA loans, hey, I got to put my house up. And not timely. Sometimes we need that money faster. Even crowdfunding, creative ways of finding money, partners, family members, other forms of non-traditional ways to find money. Now, these kinds of funding offer, more manageable terms that align with your restaurant's growth without suffocating it. But there are other ways to approach this. And one of those ways is to manage your cash flow. Now, while this is another way, you think about it, managing your cash flow, what does that mean? Maybe it hasn't crossed your mind, or maybe it has. The way to do this is you're actually talking about delaying payments to your existing accounts. While it may sound counterintuitive, sometimes managing your cash flow by delaying payments to vendors or other accounts payable can provide you the breathing room your restaurant needs. This method involves carefully negotiating terms with suppliers to extend your payment deadlines. This helps you retain the cash you need, the cash on hand to take care of your immediate needs. Through this strategy, this can strain relationships with your suppliers if you don't handle it delicately. You can't bury your head in the sand. By the way, the costs associated with these extended terms is often significantly less than the fees or interest associated with credit card loans, cash advance loans. The key is open communication and maintaining strong relationships with your vendors, making it clear that this strategy is, for mutual growth, not just, a way to withhold payment. It also means you have to have a budget in place, a cash flow budget that you understand you can catch back up. You can make those payments. You're not lying to your vendors or even to yourself. Now, by comparing the cost directly, right, these cash advances, this quick cash versus delaying payment at the interest and the penalties and the things that go along with that, it's going to become evident that while both methods involve a trade-off, the increased flexibility in cash flow management without the high cost of borrowing might be a more sustainable choice for your restaurant in the long run. Before you sign that dotted line, think about the long-term impact on your restaurant's cash flow and profitability. Remember, the goal is to build a foundation for long-term success, not just a short-term fix. Wise borrowing practices are crucial, but so is innovative cash flow management. Be sure to join me live every Friday at 8 a.m. Pacific time on YouTube, travel schedule permitting, where I'll get you pumped about the upcoming weekend, get you excited about crushing your goals and finding the motivation to be best you possible. Plus, I'll answer your burning questions live.